Volatility spiking, the VIX briefly breaking above 40 after China announced those 34% additional tariffs on U.S. imports, along with a slew of other retaliatory measures. Coming down a bit off the back of the March jobs report, we can take a look at the VIX here, but still, DataTrek Research co-founder sounding the alarm that the VIX is on the verge of signaling a bear market. Joining us now, Jeff Jacobson, the managing director and head of derivative strategy at 22V Research. Jeff, great to speak with you. What is the VIX signaling right now in your view for markets?
Well, clearly the VIX is signaling there's fear in the market. I had put in my note last week on Sunday, I thought there actually was some complacency in the market. We had basically retested the lows in the S&P as of last Friday, and the VIX was considerably lower. In addition to that, we had seen puts not really trading expensive relative to calls. And I highlighted both of those as potential concerns that we could make new lows because, both of those were speaking to complacency, like I said. So now, obviously, with the move yesterday and follow through today, we're starting to see VIX get up to, levels that usually are accustomed with fear and concern and spike, and as your previous guest said, just people paying up any price for protection. But while this is going on, it doesn't necessarily have to say that okay, well, the market has to rebound because the VIX got to this level, but it is expensive.
So what does the VIX tell you, and what does just the price action in general tell you about when we might start to see selling just getting too exhausted?
Yeah, I mean, certainly the VIX is one of them, but I would still point to the fact it's a little bit up today, but typically what I want to see and what I mentioned in my note is I want to see people just overpaying for puts, basically. I still think that there was this fear of people missing the snapback rally, and that was expressed in the fact that calls were what I would say is expensive relative to puts as of last week and even really this week. I think that would, to me, really signal the fact that people are just panicking and selling it, at any cost just to get out, buying expensive puts. I really want to see puts trade really expensive to calls. That, to me, would signal that we're potentially, at a point where the market could put in some kind of tradable bottom.
Jeff, when do you expect we'll see volatility sellers enter the market? It looks like the volatility sellers are the ones that are setting prices. And when I've seen the past volatility sellers enter the market, that's usually when you get a bottom.
Yeah, I mean, on the surface, it looks attractive. You see the VIX at 37 or 40, and you say, sure, that's a great level. I think some of that is, keep in mind, we had the first hit to the market in March, and I think that took a lot of the, leverage and exposure down. And I don't know if there's that same normal appetite. Like, for example, we had a similar move in August on the carry trade concerns. And, that was a very short-lived, it was a 3-day opportunity. It was a great opportunity to sell vol, as you can see on the chart. I don't know if people are that brave in this environment just because of the uncertainty. I think people are trying to gauge, and map out how can I price this trade war and tariff concerns. And I think it's a lot harder. And again, I think you have less risk appetite because of the move that the markets had in early March.
Can you help me understand why we saw the VIX hitting a higher peak back in August of 2024 than it's currently at? Why was there more volatility then? And does that tell you investors are missing something right now?
No, I think August was very specific because it happened so quickly. You can see on the chart,
Sure.
No one was really talking about the carry trade in a matter of days. So I think that caught the market by surprise, and people clearly, didn't have the hedge and exposure on, and it just made it that vol and options got expensive. This has been telegraphed for a while now. Obviously, I don't think the market had clearly priced in the risks of what have seen since Wednesday's announcement. But I think because it was such a short-term move, it became more of a vol event in August. Here, it's just more of a sustainable selling, and that's why we're seeing VIX kind of stay at these levels. And it will come down if the market stabilizes, but I think because of the duration of this sell-off, and it's been building for a while, we're not having that same August spike move that we saw.
And do you see hedgers buying front month puts, or are they hedging out longer term? And are they hedging at the money or out of the money?
More of the hedging that we've seen on our desk is shorter term. I mean, weeklies, maybe a month. And I kind of get that because it looks expensive on the surface. But again, the market's, the S&P is down 3.5% now, 4%. So what looks expensive when you're getting moves like this, they're realizing. And the last 2 days, those expensive puts have realized very well. Is it sustainable? No. But I think people just want to, have protection on in the short term, not look out 3 months and say, I need an expensive put that I need a 15% decline to have pay out.